It was a rough day for investors on Wall Street. The stocks really sold off. Nasdaq went down 3.5%. The Russell was down 3%. The S&P was down 2.71. And the cause of the big sell-off was the story on tariffs. Oh man, looks like Pedro Miguel, you brought it up, and I agree. Tariffs. So tariffs, and I think President Trump came out and said he's putting 100% tariff on China stocks or China products, excuse me. Man, that could be so disruptive in so many different ways. He really turned up the temperature on that negotiation. And if it stays ugly for a week or two or three, I think we could be down 10, 15% because the market leading into this sell-off was expensive. And some stocks are just going up 5, 10, 20% in a day is just normal, especially those stocks that have no fundamentals. It's just, the big story. AI is going to be so big. Data centers are going to get so big. We're going to have to dedicate a good portion of our electricity just to power these data centers. So we'll see how ugly this gets. Meanwhile, we have a government shutdown, and that's less of an impact on stocks because, it's an impact on government operations and things that need to happen at the federal level. But eventually that will hurt the economy to some extent because the people that are at home, unsure if they're going to have a job, they're not going to spend any money. And the neighborhoods and the areas they live in will probably not see the economic activity they typically see. It'll probably go down. I don't think it's going to make a major impact, but I think that just adds to kind of like the negative sentiment, right? We've got stocks selling off. We've got just a lot of things not going right. And it's a good day to stream just to talk it through. More importantly, sell-offs are just a natural occurrence for stocks. We invest in stocks in a lot of ways. The market is very emotional. On days like this, it's certainly selling off fast with the fear that, hey, these tariffs are really going to disrupt commerce. It's going to make prices more expensive. It's going to hurt the consumer confidence. And our economy is dependent on the consumer, where pretty much 70% of the economy is the consumer. So if the consumer is scared and starts spending less, then the economy is going to take a back seat. So it was an interesting day with the news being that tariffs are really causing a lot of concern. Looks like Genetic Smite. Thank you for becoming a member. I really appreciate it. Please get me your details. I'm going to put my email in the chat. If you can email me so I can get you a list of your perks. And I really appreciate it. And if there's a stock you'd like me to look at, please put it in the chat and we will go over that. All right. And it looks like we've got Herdo. How you doing, Herdo? Good to see you. It's great that it's Friday. Looking forward to the weekend. I kind of wish we were heading into the weekend on a more positive note, but here we are. Big sell-off. My portfolio took a pretty good hit. The stock market with this sell-off, it took a nice bite out of my profits in 2025. I'm still well in the green, but today was a pretty good bite. It was like a shark bite out of my gains. Hopefully you did okay today. And the volatility is going through the roof. And they saw the reading. I think I heard it was like around the 50th highest volatile day in the history of Wall Street or the market. If it's just one day, I don't think it's going to cause big, damage. But if we stay in this zone of negativity with maybe the US and China arguing, for 3, 4, 5 weeks. Heck, maybe they go until December. This could really be a real dark cloud over stock prices. It could lead to stocks selling off 10, 20%. Now, for the last, call it month, 2 months, I've been putting it out there that I was getting concerned that stocks are getting expensive, and it is fun to see a portfolio go up in price, but it was getting a little too frothy, a little too exuberant. So I started to sell some stocks, sell some shares, create some cash for this situation. Or maybe even, I'm not jumping in head first on this sell off, this dip. I want to see how far it goes. I want to get more information next week. I did buy some stocks today. I'm a dollar cost average investor. So I was able to buy some stocks that I felt like, hey, if you want to reduce the price on that stock today by a good amount, I'll take some shares. Thank you. But I've got enough capital to operate really through the rest of the year. If I had to buy stocks, or if I wanted to buy stocks each week for the rest of the year, I'm good. So, and the reason for it is I've got a good balance sheet, so to speak. I've got good cash to use between now and middle of November. In November, I have some individual bonds that are going to basically redeem. And that can fuel my buys in the latter half of November and in December. So I'm in a spot that I feel comfortable in. I don't like to see stocks sell off, but in a way, what investing has taught me over the last 35 years is sometimes when things are really bad is the best time to invest. And this has certainly been the case coming out of like the big recession or the Great Recession that was 2008, 2009, 2010. I actually put a lot more money into stocks and I put money into real estate, and I did really well, especially on the real estate side. Fast forward when we had the tragic 9/11 situation, or actually that was before. Again, the stock market sold off because there was a lot of fear, and I was able to buy stocks at a discount. COVID, ditto. I put more money in and it really benefited me. 2022, I put more money in and I really benefited from it. So I don't cheer on the big sell-off and all right, yippee, here we go. I'm losing money. Yay. No, but it's if used properly, sell-offs are a way for me to get really good prices on great companies. And I'm always in the mood for that. So we'll see how far this goes. All right. So Pedro Miguel, good to see you. Thank you, sir, for tuning in. And yeah, Herdo, it was rough. Let me know, Herdo, if there's a stock out there you want me to take a look at. Metal notice increase. And yeah, I really appreciate that, Genetic Smite. And I really want you to get as much value as you can. Please get me your details and keep bringing questions to the live streams. Let me know if there's a stock you want me to look at. I really appreciate it. All right. And it looks like Magical Self. Good to see you again. You want to take a look at Nice Software. Be happy to look at Nice and take a look at that stock. All right. So I talked about 2 out of 3 topics that I wanted to touch on. And the third one is just kind of a high level topic. And that's the AI bubble. Now, we could argue about is it a bubble? How big is it? How long is it going to last? Can it go on for a couple of years? All those things are pretty much up in the air. Like, I think we are in a bubble. I don't know when it's going to stop. I don't know when the music is going to end. I don't know when we're going to have that moment. Like today, I think we're going to get surprised by something, and that's going to kick off, a different mentality, sentiment, kind of investor confidence. And once you get going down the hill and you get that boulder rolling down the hill. It's really hard to stop it, and we'll see when it happens. I truly believe we're in a bubble, and it's not a bubble that, I'm imagining. It's pretty you could see it in the numbers. Not only that, some of the brightest minds in the AI space that stand to benefit from the success of AI have gone out there and said there is a bubble. The first name, Sam Altman. It's about a month old, but he said, we're probably in a bubble. There's probably some stocks that really don't deserve, and they don't belong in the economy at their particular definition and at their valuation. So he came out with that. It certainly caught everybody's attention, but the market didn't, get too fearful about it. They just kind of moved on. The next mind that is very, very informed is Jeff Bezos, the founder of Amazon. Amazon stands to really benefit from AI. They have the biggest cloud infrastructure business in the world. And as companies build out AI and make it as big as they need it to be, they'll buy a lot of services from Amazon. So if anything, he would probably say things that probably weren't going to hurt Amazon, but he was talking in Italy at a tech conference, and he said that we're probably in an industrial bubble. That it's too easy for a lot of these companies and I think he said it to the extent of a couple guys with no real business can get a couple $1 billion fairly easy nowadays. And he said that's too euphoric. It's too optimistic. And I understand exactly what he's saying. So Jeff Bezos called it out. Next one is a very successful investor that has been through a lot of markets ups and downs. Paul Tudor Jones. He's a very successful investor. And he said we're in a bubble, but he also said this bubble can go on for a year, 2 years, 3 years. It could keep going. And he said you can make money if you know how to get in and how to get out, but you don't want to be going down with the Titanic, so to speak. So Paul Tudor Jones, made those comments. The next two guys, lesser known, but they are very successful. Orlando Bravo, he's a billionaire investor. He made the comment that we're in a bubble. The last one is Daniel Newman, another very successful investor. And these are all things that have happened over the last month. So it's not just, the numbers that we're seeing, the valuations, and we're seeing like on a day like today, just these ideas are so far-fetched. Oklo is a company that's trying to make a power generation solution for nuclear. They're trying to make these small nuclear reactors. And they're quite a ways from even making $1 of revenue. And their valuation just keeps going up. They were up 9% on a day like today. That is just so ridiculous because they have no fundamentals to value the company. And they keep going up. So that is very interesting. And I think kind of shows the exuberance that some of these stocks are being traded with. And we'll see how it ends. The dot-com bubble, I was an investor. I was much younger. That was 25 years ago, roughly. And it really crushed the market. I don't want that. I was a young man then, and I kept putting money in the market. I'm glad I did so, but it took a couple of years to kind of get back. I don't know that we're near a point like that. I would think that we're smarter now and less greedy, but we'll see. We'll see how it goes. Looks like Little J is on. Good to see you. And Cartel Raider. Team fundamentals. Good defense wins championships. And then Little J, you got a comment? Yeah, today everything in my portfolio was red, but for two stocks. The two stocks were nice safety stocks. One of them was CVS, the pharmaceutical company, and the other was Kroger, the retailer of groceries. So no matter what happens, we're going to have to buy groceries and we're going to have to go get our prescriptions at CVS, and those stocks went up. Those are two good winner stocks for me for the last 5 years. Really, Kroger for the last 5 years, CVS for the last year. It's been doing really well. And I'm really glad to see them pop up. And I'd like to buy some more stocks that maybe could do well in a period like this. All right. So let's get into some stocks. And in case you're new, I look at fundamentals for companies. I'm going to look at their free cash flows, try to forecast how much cash is this business going to make. And I'm also going to look at profits. How much profit is this business going to make? And then try to do a net present value of the cash flow as well as the profits, and try to estimate what I think per share the stock's worth, compare it to the current stock price to see if it's being priced above or below its intrinsic value, and do just qualitative analysis on a stock and seeing if it's an opportunity or if it's priced too high. The first stock we're going to lead off with is NICE, which is a software company. And I'm familiar with NICE. I've looked at it a few times over the last 6 to 9 months. Let me kind of read off the description. So NICE, together with its subs, provides AI-powered cloud platforms for customer engagement and financial crime and compliance worldwide. It offers CX1, Mpower, and an AI platform that enables enterprises to design, build, and operate customer service automation. And NICE Evidence Central, a digital evidence management and investigative platform for criminal justice system. Interesting. Okay. So when we hear the word CX, it's CRM. It's customer service for those types of operations for a business. And these guys are a good company. You're going to accept all the cookies. And it looks like they're one of the leaders, according to Gartner. And NICE is way up here for contact center as a service. So they're ahead of Genesis, which is a longtime player in the space. And they're ahead of Amazon Web Services. They're ahead of Cisco. Interesting. Okay, so I know what they do. They're a software solution company. They're also trying to get into using agentic AI to provide businesses a tool set so they can build AI applications or bots that could do the work that you would otherwise hire somebody to do. Right now, that should be really, really interesting. This business has sold off this year, down 21%. Over the 1 year, sold off. 5 year, sold off. And this shows a consistent undesirability to the market. Market's looking at this business going, we're not quite sure we really like this business. We'll look at the fundamentals and we'll see what they have there. This is a small cap, 8.65 billion. This company, I believe, is headquartered in Israel. Yeah. Headquartered in Israel. They have revenue of 2.84 billion. So you're paying less than 3 times revenue. That's not too bad. P ratio is 16. I know that they're growing. So 16 is a fairly attractive PE for a growing business that has high profits. And then the forward PE is going to drop to 10.28. Analysts believe it's discounted by 52%. When we look at the business, it is growing. It's growing by 11% looking at the trailing 12 months. Last year, full year, they grew by 15%. Looking at the quarterly, things slowed down in the first quarter, but then they are picking up speed in the second quarter. It's going to be very important for these guys to continue to grow. And if they stop growing, then the market was right. This business is not as desirable as a business that's really growing. They're going to announce their earnings November 13th. So it's going to be roughly a month from Monday, because Monday is the 13th of October. So they're growing at a low teens number. They do produce good amount of free cash flow, $728 million. Their gross margins are good. They're not great. They're on the boundary of good and great. Profits are good, 19%, and free cash flow, 25.67. So combined, this is a good software company. It's not great. It's not growing incredibly high, and they don't have very high gross margins. They don't have very high profit margins. So collectively, it's okay to good with regards to a software business. We look at what analysts are seeing out there. There's 13 analysts covering it. Some analysts believe this is really discounted. This is a $300 stock. And the worst case, scenario is $150 stock. So all scenarios lead to a higher stock price, 52% discount. If we look at the consensus of what their price targets are, it's expected that they're going to grow, but they're not going to grow as fast as they grew in the past, growing about 7% in 2026 and then 10.7. Now, these guys are saying that they want to create, or they want to provide businesses a platform and tool set to create AI functions that are going to be agents that do the job that would otherwise be done by a person, that could really reduce the cost of doing business and help businesses be more efficient and maybe even grow. That's what they claim they're doing. Now, what's important is you got to grow this top line so you can show Wall Street that, hey, our AI products are really growing. Customers love them so much that, if they can grow like at 20%, boy, this stock will really go off the charts. But if they're going to grow single digit, I don't know if these guys are ever going to catch a whole lot of excitement and a whole lot of attention from Wall Street. Their earnings per share will grow, and unless the stock price goes up in price, it's going to go down to single digits, which I don't think is right. I think if these guys are a slow to medium growth company, they're profitable, generating cash flow, at least an 18 is applicable. So they're trading well below an 18 PE. So this is likely very discounted. Now, NICE is very similar. I would say the number one company out there that competes with NICE is CRM Salesforce. So let's see where those two stocks have gone, where they've been, and see if we can see any similarities or differences, see if one's outperforming the other. So there's CRM, and who else would I put on there? ServiceNow. ServiceNow does very much what NICE software does. ServiceNow primarily works within customer service and doing those types of operations. So let's look at year to date, and these guys are all hurting. You got Salesforce is down 27, NICE is down 21, ServiceNow down 13. So I think the stock market is not quite sure how to treat these software companies. They're looking at them going, I get that they're growing. I get that they're making money. I get that historically these have been really desirable businesses, especially Salesforce. It just doesn't know what to do with them. And I know I could show you a discounted stock in Salesforce. I'm going to show you the valuation of NICE in a minute. And ServiceNow has also been beaten down. So it's the whole pack is being taken down in price. Let's take a look at the value of Nice Software. So Nice Software is discounted by 38%. The cash flows are good, growing nicely. It's a profitable enterprise. They don't have much debt because they have more cash than debt. And just giving them a PE of 12, which I believe they deserve an 18, but trying to be realistic, the market is just not giving these companies a decent price to earnings ratio. And when I put those numbers together, I put more weight in the free cash flow, discounted free cash flow valuation. I get a 38% discount. I use a higher than typical PE discount ratio because Nice Software is headquartered in Israel. I'm in the United States. It's out of my home country. It's out there doing a lot of business in Europe and around the world. I can't keep an eye on it. So I deserve a higher rate of return for the additional risk I'm taking. So overall, this is a very, very good business, discounted. But I could show you a very similar discount for Salesforce. And I'm more comfortable with Salesforce. Salesforce is the leader of the pack. They're the biggest. They're growing just about the same rate. Actually, they're growing a little better than Nice Software. They have terrific profitability. So Salesforce is the one in the pack that I'd rather own. It is the one that I own. And the reasons being, these guys are much bigger, more well-known. They're growing, and their cash flow is very high. Gross margins of 77%, while Nice was, I believe, around 60. Profit margins are good. Free cash flow margin, nice and high at 31. So Salesforce is not being bought by the market. The market's somewhat not confident that Salesforce is going to be a player for the future, but they are a very big company growing at 8%. And that's pretty good compared to other software companies that are the scale and size of Salesforce. That is very good. So the market just doesn't like software companies like Nice, and that's what's been happening. What do I expect is going to happen? Well, assuming we get through this tariff entanglement with China and we get to a point that's agreeable to both sides, get that out of the way, I think eventually we're going to come to a day when these software companies are going to be are going to redeem themselves. They're going to show that the market was wrong about them for a combination of things. I don't think AI is going to disrupt them. I think they could actually use AI in their favor, providing customers more benefits, features, more value delivered to that customer that uses their software and technology. And therefore they can charge higher prices or maybe charge for a product that was created in the last couple of years. So I think that's the opportunity for Nice Software as well as Salesforce as well as ServiceNow. So that is Nice Software. Hopefully you found the analysis interesting there. Looks like Mike's got a comment. Good to see you, Mike. Yeah, so this space has been really tricky. I have not gotten a lot of gains out of software. They've been short-term gains, but no long-term super winners. There's a couple of super winners in software that I could point to. One of them is Palantir. The other one is AppLovin. But these more traditional software players, they just haven't caught a lot of attention, positive attention from Wall Street. So they're going to be tricky. We'll see when things turn around. Carlos, good to see you. Thanks for joining. All right. So again, if anybody has a stock you want me to look at, I'd be glad to look at it. If you're a member, just put it in the chat. We will check it out. If you're not a member, $5 super chat or become a member. That'd be great to have you. Increase. CRM barely dipped today, considering. Yeah, you make a good point. Well, 1.45 is a sell-off, but I get your point that other stocks sold off quite a bit more. The next stock I'm going to look at is a stock that sold off considerably more. And that is a company by the name of Futu. Futu is a lot like Robinhood. The difference being is these guys operate in China. And they serve and actually operate out of Hong Kong, which is China. It's just kind of like the part of China that used to be more independent. And you can see that even though we had a pretty good haircut today, 11% down, it's still been rocking. 93% return year to date. And man, I find it so fun to find these discounted stocks, buy them at the right time, and then watch the investment go up. And that's been the case with Futu. I wanted to look at this just to, one, do my due diligence because I'm a stockholder, but two, is kind of show an example where this could quickly become a great opportunity, or it could be a sign that, hey, these guys may be hurting for a while. But let's analyze them and see what's going on. So again, they're in Hong Kong, $21.5 billion market cap, and they have revenue of $2 billion. So you're paying about 10 times revenue, just a tad bit above 10. They are growing, I could tell you that because I know them. P ratio isn't up to where Robinhood is. Robinhood's way up there. Even Charles Schwab, Interactive Brokers, they have higher PEs. And the difference being is when you invest in a company that's in China, it's just going to be automatically discounted beyond what the U.S. comparable company would be priced at. I actually like owning a company in China that does brokerage services because in China, as well as other Asian countries, they save a lot of their money. They're big savers. And they, I am sure, are seeing how stock investors are flourishing. They're seeing Alibaba stock go up. They're seeing C Enterprises go up. They're seeing just American stocks go up. And their banks are paying them just a real small, interest rate. So that type of savings going into the market is a huge opportunity for Futu. So I like that whole situation. By the way, I own Robinhood as well. I own a big position of Robinhood. It's doing great. It got a little shellacked today as well. This stock is discounted according to analysts by 33%. Now, what's exciting about Futu is the growth. 69.5, 31. These are really good numbers. And you see that they're accelerating their growth. And I think a lot of money is coming out of these savings accounts and going into the market. More account holders funding their accounts, investing in stocks. And for the most part, Chinese stocks are up quite nicely. And I think investors are getting really accustomed to better rates of return from stocks versus just putting your money in a savings account. So it's a really nice organic growth for this company. 69% is very good. They grow really well. They produce good free cash flow, and they have terrific profit margins. So it's a nice combination. 5 analysts cover this stock. One analyst believes, hey, this thing can go to 270. And the most bearish analyst believes it can go down to 136. The downside risk isn't too bad. Collectively, consensus discount is 33% discount. They just look at earnings per share, and I look at the company earnings per share as well as free cash flows they generate. It's expected that these guys are going to keep growing. That looks really good. And their profitability is going to expand as well, bringing down their PE ratio. But I think the stock will probably rally. So Futu got a pretty good haircut. I did not buy more shares in Futu. I am waiting for their earnings to be announced. I would say that if they start selling off at these rates, I'd probably buy some shares if they got down to $130 a share or something. But I think we'll see what happens next week. When I look at the valuation of Futu, it's nicely discounted. And so is Robinhood, by the way. Both really nicely discounted stocks. So that is Futu. Let me look at the chat here. So KJ, thanks for joining. And if you'd like me to look at Meta, $5 super chat or become a member and we can talk about Meta. Mike, worried about Qualcomm. Qualcomm, and on a day like this, right, a lot of stocks got shellacked. There was a combination on Qualcomm that happened. First, the Chinese government decided that here it is. They're going to start probing because Qualcomm chips end up in a lot of handsets, a lot of mobile phones, and a lot of the phones that Chinese manufacturers like Xiaomi, Samsung uses Qualcomm chips big time. I believe Qualcomm's in the iPhone. It's in the Android, or I should say the Pixel. So we have Qualcomm chips in many, many handsets. And the Chinese government, I guess the investigation is Qualcomm too dominant in that space? So that was the first bit of concerning news. And then, of course, later in the day, we had the big news that, hey, the negotiations on trade maybe weren't going as well as they should have. So the president kicked it up a notch and first announced, hey, he's going to put up some big tariffs until, he can work things out with China, suggesting push them to kind of do what he would like them to do. And then later on, he came back and said 100% tariffs, which is huge. Well, the Chinese government can retaliate, but I don't think they're going to retaliate too harshly on Qualcomm because Qualcomm is being, used in handsets. And if they have their consumers that obviously everybody has a phone now and their consumers are like, hey, I used to pay $200-$300 for a phone. Now I have to pay $500 because Xiaomi and a lot of Android based devices are far cheaper than iPhone. Then that consumer base is probably going to get quite disappointed with the government of China. So I don't know if they're going to do a whole lot there to cause a big population dissatisfaction. But that's just me thinking out loud. I think Qualcomm's going to be fine. They're growing quite nicely and they're very profitable. I really like the value of Qualcomm. The reason this semiconductor company hasn't rallied up like NVIDIA, Broadcom, and others like AMD is they're not in the data center. They're in the mobile device. That is where they make their money. And obviously that's going to continue to be in demand. And Qualcomm's going to continue to grow. But they're not in that very desirable space, which is the data center. And the market's really trading on that story. So Qualcomm is being left behind. I think long term, this is a very good hold for me. I own Qualcomm stock. I think their revenue growth is very good. Let me show revenue growth, and then I'll go to my valuation. So 15%, very consistent growth. And this is a big business. $43 billion in annual revenue growing at 15% is very good. Look at their gross margins. Good gross margins. Not great, but good. Profitability is there. So good profitability, good free cash flow yield. Those things look very, very good. Now for the value of Qualcomm. It has a very nice discount of 44%. And that's looking at their cash flows and their profitability through earnings per share. So that looks really, really good. I really like Qualcomm stock, and it has a terrific balance sheet, almost as much cash as debt. Pretty soon, I'm going to be taking the discount rate down full percent, going to 7.5 because interest rates are falling quickly. You may have noticed it today. Interest rates fell quite a bit today because the move from equities to bonds creates higher bond prices, which brings down yields. And as the interest rate yield goes down, the discount rate on stocks will go down, making stocks more valuable. So I'll be updating probably my discount rate on most of my new valuations with a 7.5 for a company with a quality balance sheet. And then from there, depending on risk, working off of a basis of 7.5, which, before these rates started to drop, it was an 8. I'm also expecting interest rates are going to continue to drop for the next 3 years. That's my expectation. It's what our president would like to have, and he gets to select the chairman of the Federal Reserve, and that person's role would start in May of 2026. The existing chair of the Federal Reserve, he's communicated that they intend on lowering rates. So between now and May, we should see rate reductions, and interest rates should be lower for 2026, 2027, 2028. And we'll see how things play out. So that is Qualcomm. It's a very good value stock that is growing. So I am good with my investment on Qualcomm. We may have to hunker down because a day like today, where you have a huge sell-off, the NASDAQ was down 3.5%. I mean, that's a pretty good, that's a pretty good down day. And next week, what are we going to have? Are we going to have a couple of days like this? Are we going to have a little bit of a rally on Monday? I don't know. We'll find out together on Monday, but it could be uglier if we stay in this sell-off mode. Maybe we sell off by 10, 15% collectively. It shouldn't be, a distant memory that back in March, we went down this road, and we went down, the S&P went down 18%. The NASDAQ was down even worse. It was down like 20%. And very quickly, over the course of like a month, we went from to, hey, stocks are down 20%. Some stocks were taken down much harsher than others, and they became really good opportunities. We'll see how far and how deep we're going to go this time. We're going to see if it's just a one-day blip or if it's going to be something more significant. One thing that I wanted to look at that we haven't seen is the last 5 days. So for the 5-day, we're down 2.7. Interesting. No, wait, maybe I'm not looking at this right. So 2.71. Yeah, it's exactly 2.71. Interesting. It just stayed the same. So we were kind of even before the day started, and today's fall is what is going to measure the weekly fall. I thought it was going to be a little higher because we did have a sell-off day on the 7th and then again on the 9th, but we did have a couple green days. So the green days and the red days kind of equaled themselves out, and then today represented the loss for the week. All right. So we went over Qualcomm, Magical Self. So I did buy EQT. EQT is focused on natural gas. And as I look at how much natural gas is going to be consumed, and when we look at power generation in the U.S., I think about a little over 40% of power generation is dependent on natural gas. It's also a fuel type that if you wanted to build a new data center and start powering it, what would be quite the path of having practical power generation would be a turbine burning natural gas. That would do it. You could create power that way and power your data center. And that's exactly why I'm buying EQT is I think the demand for natural gas has been going up. The price hasn't been rallying a whole lot, but I think that could change. And these guys have been a very successful stock. I feel like I might be paying up for the stock, but I feel like I'm paying up for quality. It's gotten it done for 5 years. It's gotten it done for the 1 year. It's just every angle. I'm liking what I'm seeing. Had a down day today, and I started a position on EQT. It pays a small dividend. I don't care about dividends, but it pays a small dividend. And these guys are growing quite a bit, 59% in the trailing 12 months. So I did start a position in EQT today. I also own Occidental Petroleum. I own much more of that stock than EQT because I just started buying into EQT. I also own a lot of Chevron stock. Both Chevron and Oxy produce, they produce petroleum as well as natural gas. But these guys are purely a natural gas player. That's what I wanted. I wanted that type of exposure. And here I am. Let me show you my valuation of EQT. For members, you guys saw this company in my review of oil companies or energy companies, and they're discounted by 24%. Occidental has a better discount, but they're not a pure play natural gas player. I'm still buying Oxy. I bought Oxy stock today, bought some more shares, but EQT is a new position in my portfolio. So, all right. So moving on to the next comment. Let's see here. You're right about Qualcomm. China is a big market for them. And Mike, you're waiting for EQT to get down to $50 a share? Well, we're close. We're close. Just another day like today, and we're getting even closer. And I'll be buying if it's going down. So I guess I'm okay with it going down. All right. So we got through that list. Michael Anthony, good to see you. Thanks for joining the chat. All right. So I've got a list of other stocks. Let's take a look at the next stock will be Zeta. And Zeta is a software company. They're in the ad tech space. And they're in the green just slightly. They were headed in the right direction. Now, a day like today, everybody gets a haircut, it seems. But boy, 9.67, that's pretty extreme. They are a small cap. So you'll see when we have sell-offs, the small caps tend to sell off much faster. So here's an example of that. This company is growing well. It's profitable, has very good fundamentals, but the market isn't familiar with this name. It's one of the smaller names in ad tech. As we look at the stock for the 1 year, it's down, and it's really had a roller coaster ride. It really flourished here in 2024, but then it came back down to earth. It's a nice grower, 40% on the trailing 12 months. This is a software company. I like that 40% growth. I like their gross margins of 61%. Hopefully they can make those margins go up as they get bigger. Free cash flow looks good. And profit margin, not quite there. They need to get a little bigger and get profitable, but they do have a free cash flow yield already. They have that really good growth. But I like seeing the growth, especially accelerate, is you're seeing the opposite with some of their competition. Now, these guys are small, but the trade desk, their revenue isn't growing as fast as they would like. And there's others that are contracting, like Viant. And I think they're contracting because AppLovin and Zeta are putting out a product that is better, that customers like more. And they're attracting more customers, maybe taking them away from competitors like the trade desk and others. So I like that acceleration. It shows that this is a strong business. Analyst, 13 of them cover this stock. And there's some analysts that are very enthusiastic about this product, saying, hey, this stock is worth $45 a share. The most pessimistic one says, hey, it's fairly priced. So there's very little downside risk, according to analysts. It's discounted by 52%. And the growth is really good, and the company's supposed to grow high teens. That looks good. Their profits are really going to expand nicely. So that looks good. Either their PE is going to go down or their stock price is going to go up. And I think the latter. I think ad tech is not like nice software or CRM, where that particular industry or type of software company is kind of being left behind. But ad tech is really doing well. If you consider AppLovin's in the space, these guys are doing okay. Not quite as good as AppLovin. Now, these fundamentals look really good. Let me show you the valuation on Zeta. %40 discount on Zeta. And I think lower interest rates are going to help small caps. When you get these low interest rates, it's almost like the risk on trade, really gets more popular, because if you hit on small caps, you can really have a great rate of return. And what are you going to do with that money? Put it in bonds and make almost nothing? Or, I think people are more inclined to take higher risk when they have very, very low interest rates. Plus, the economy tends to do better. And companies like Zeta are probably helping businesses advertise more when you have a healthy economy. So Zeta is discounted by 40%. I have AppLovin right above it. Right now, it's discounted by 2%. And today, I bought more shares of AppLovin. I really like this company. It's far bigger. It's the leader of the pack. It's getting it done. It's growing really fast. And I want more shares. It's been a successful investment so far. I own a small position of Zeta. I just didn't buy any more shares. I just waited because I'd like to see their earnings announced, which will be in a month, and get more information. It's a smaller cap. Right now with the stock market, it's a one-day sell-off, but it was pretty harsh, pretty intense. I'd like to take my time. I don't want to jump in head first and start buying stocks left and right. I'm going to dollar cost average. Zeta, I have a game plan. I'm doing fine with the stock. I'd like to get to their earnings announcement, get more information, and then revalue the stock, and then make a decision on whether to hold or buy more shares or even sell the shares that I have. So Zeta got a pretty good haircut. Got a buzz cut today. Got like a nice marine style haircut today. All right. So Magical Self. Do you believe SPGI future? All right. Let me take a look. So SPGI, Simon Property Group. So Simon Property Group is a self-administered, self-managed real estate investment trust. Okay. So I believe that Simon Property owns a lot of commercial properties. So they develop, manage premier shopping, dining, entertainment, and mixed-use destinations. Okay. And there's, the distinction is important. I know for a while, commercial property owners, they were not, commercial being like office space, not doing great. Retail, malls, it's a little risky right now. Everything's going online. It seems like, these are fun places to go to, but people are shopping online, right? They get better deals, but you can go out for a coffee, go out for dinner when you go to these places. So that's what these guys are doing. They're doing a lot of mall properties. Okay, got it. Let's take a look at where the stock price has been and where their fundamentals are at. So year to date, 1.79. They do pay a nice dividend of almost 5%. And you may know that when it comes to real estate investment trusts, in order for them to maintain that type of stock class, they have to distribute a proportion of their funds from operations, a high proportion. So they dividend out a lot of their gains. And these guys have been providing that dividend. I'm going to see if it's affordable to them. P ratio is 27. All right. The target price target, are 6% above its current stock price. It's a $66 billion market cap company. All right. They've grown quite well over the years, and the trailing 12 months growing by 3%. Okay, that looks good. And I don't need to look at margins and so forth because a real estate investment trust, I have to treat differently. I don't look at margins and free cash flows. I look at funds from operations, and then I look at the earnings per share. And based on earnings per share, 13 analysts cover them. Best case, one analyst believes this is a $225 stock. Worst case, $169. The consensus is it's discounted by 6%. It is expected that these guys are going to keep growing at a slow rate, and they're going to expand their profits at a slow rate. So their PE is kind of staying steady. And real estate investment trusts, it might be a little too ambitious to think, hey, I can get a lot of price appreciation over time investing in a company. These guys, the reason you're seeing this type of appreciation is this was the COVID low. And these guys were really struggling because COVID banned malls for the most part, right? We weren't allowed to go shop for non-essential stuff. And a lot of their malls, you can make the argument that no, essentials to me are going to get a new pair of sneakers. Well, maybe. Or having a lady buying a fancy gown. Well, maybe, but maybe not. So people were kind of hunkering down. And the stock price really went down. So yeah, if you bought it then, you're looking at really good appreciation. But the conditions are back to normal. And you can see that over the 1 year, this is what you're probably going to be making. And this is not keeping up with the S&P. Older investors like real estate investment trust because it provides that income. And I get that. Some investors want the income out of dividends. I kind of follow the school that Warren Buffett likes to, talk about, which is that dividends are tax inefficient, that you're being distributed that dividend. You may not need the dividend. You may not want the dividend, but you're going to have to pay taxes on it. So that is one thing that is undesirable. If I needed cash for my portfolio, I sell some shares and I'll probably pay a long-term capital gain, which is lower than a dividend, which is ordinary income. So that's just one thing that I would point out there. And be the investor you want to be. If dividends are really important to you, They serve a purpose. You like them. You stay in your lane. You keep doing you. I'll keep doing me until it stops working. And, I think I'll be just fine. And I think you'll be fine just as well. So let's take a peek at dividends. So these guys, they're paying out that dividend ratio. Now they're looking at their earnings here, but we really should see funds from operations, and I'll try to dig that out for you. The good news is dividend has been going up. So that's good. And you really want to see funds from operations, and they should be paying out like 75, 80% of funds from operations. So let's take a look. This is the income statement. Let me see if I can find funds from operations. If not, then I'll move on. Nope, they don't have it here. You'd have to dig it out of the investor page for Simon. And I'm pretty sure they're just following the guidelines that REITs have to follow. So this stock, I think could be somewhat of a lower volatile stock. It's just going to go up a little, pay that nice income. And if we have these massive tariffs, that could hurt the retail space, right? I don't know that we're going to be in that, high tariff zone for a long time. I think they're probably going to work things out. Maybe takes a couple weeks, at worst takes a couple months. And it's a blip in the economy, but we'll get back to, hey, if we're going to buy stuff from China and they're going to buy stuff from us at some point in the near future. We'll see when it happens. So that is Simon Group, a real estate investment trust. Good investment for those that are seeking income. And I own one real estate investment trust, CTRE. It's done well. Happy with it. All right. Mike, the dividend investor guy. So we had a cremation, but nobody died. Dave and Monday. Oof, let's take a look. So Dave is a new financial services company. Well, Dave did go down, but boy, 5.6 on a day like this for a small cap doesn't seem like a lot. I just showed Futu that was down 11, and then another one. I think Zeta was down 9. So this one down 5.6 is a bad day for sure. And this one's kind of been having a bad month. Year to date, this one's having a great year, although it's kind of plateaued to some extent. Now, I really like what Dave's doing. They have like a new experience for financial services. I really like that. I think that especially around financial services, the older companies, legacy companies, they don't connect really well with the way people are really living their lives, right? Like my wife, for example, she's always connected with her friends and relatives on her phone. It's great. She's always in tune. And I'm also connected, obviously I'm connected right now with you guys and my kids as well. But a lot of financial companies are still advertising on TV and doing things like they were doing them 20, 30 years ago. It's like, guys, get with the program. Well, Dave is completely different. They're giving you a user experience that's far better for financial services. I really like that about them. And I think that, as we kept going up in stock prices, I decided to sell my Dave shares just to create cash and kind of go down on the risk. And I could see myself buying this stock. Once we get through this sell off, I don't know how deep we're going to go, but I could totally own this stock again. They announced on November 11th, and I think they're discounted. Let's see what their financials look like and what analysts are saying. These guys are growing nicely. 49.97%. Really nice growth. It is a small company, and they have good free cash flow, excellent margins. We've got 6 analysts covering the stock, and one analyst believes this is a $320 stock. Worst case scenario, 177. Consensus, 36% discount. These guys are going to keep growing, although the growth is expected to slow down. It's the job of Dave to figure out how they can keep growing at a high rate. If they slow down like this stock isn't going to go as high as it could. They have to figure out how to grow. So it'll be really interesting to see what they have to say on November 11th. Study that earnings announcement, see if they're really optimistic about the future, and see where they're going. The valuation on Dave is good because they're growing so fast. They're driving free cash flows. That is what I want to invest in. And these guys are, based on that growth, 62% discount. And again, as we get lower interest rates, these valuations are going to get even better because lower interest rates would drive a higher value. For example, I changed this to an 8. We went up in value. So this one here looks good. Good balance sheet, more cash than debt. And it's nicely discounted. I'm probably going to get back into Dave. I'm just going to let some of this, let some of the air out of this balloon that we have in the stock market and probably get back into Dave. And the other stock was Monday. And Monday as well Monday's a little bit like the stocks we covered, which was Nice Software and CRM. They're discounted nicely. And I had Monday, and I decided to switch horses because Intuit was really sold off. And Intuit, in my mind, is one of the best companies out there, especially in the software space. So I just switched horses and went into the Intel stock and sold my Monday stock. I don't like owning too many of the identical types of businesses. When we look at Monday, that's what they do. They do small business software to run the accounting and stuff like that. So this is a good company, discounted, and a small cap. If they keep growing, this stock price is going to be just fine if they keep growing. Looking at Monday, let's see if there's any news on them. Analysts think it's highly discounted. $9.5 billion market cap company. All right. They're good growth company, 30% growth, 1.1 billion in revenue. They have good gross margins, really high gross margins, and profit of 3.63. They're little. As they get bigger, that profit line is going to expand. The free cash flow yield is 29.5. Those numbers look really, really good. 23 analysts cover this stock. That's a lot of analysts. And they all think it's priced below its value. And they're all looking at earnings per share. But boy, everybody's agreeing. This one's a good one. So it may take a little time, especially since we're in a sell-off, before this one comes back. But this one's looking good, especially if they keep growing at these rates. This one's going to do well. It's just going to take a while. Over the 5-year, it's only up 19%. The fundamentals look good. So that is interesting. And as mentioned, I went into Intuit. Intuit is just such a well-known company. It had been sold off, and I decided, hey, with this sell-off, it opens up the door. I am going to buy Intuit. It's a bigger cap, very well-known company. Um, Analysts think it's discounted, not quite as high as Monday, but Monday is a small cap, lesser known. And what was interesting was this one didn't lose much value today. You see where investors are more comfortable, more confident into it because it's such a well-known company. They have products that just about everybody uses, like TurboTax. They also have Credit Karma, I believe, is one of their products. They have QuickBooks, which a lot of small businesses use. So this is just a really well-known company that has good growth on a big number, 18.8 billion. And they have very good margins, 80% margins, profit margins at 20%. So the fundamentals look terrific. It was an opportunity to get into a great business. And as the stock sells off, I buy shares. So I'm glad to load up on Intuit. I think it's going to be worth more in the future. So hopefully we get through this sell-off, Mike. I don't know if it's going to last a couple of days, a couple of weeks, or a couple of months. But I am optimistic longer term, like over the next 3 years, we're going to have lower interest rates. And lower interest rates are going to mean that stock prices are going to go up because the discount rates go down. It makes stock prices more valuable. So over the next 3 years, I am bullish, but I am bearish or a skeptic when it comes to like the AI bubble. I think there's a bubble there and it's kind of dangerous. I think when it pops, some businesses are going to be looking really overpriced substantially. And we'll see if the AI space can deliver great revenue growth and profits, and not necessarily the hyperscalers. They're selling capacity, but I'm talking about the businesses like Nike, like General Electric, businesses that are supposed to be taking AI, doing something with it to make their businesses more profitable or even grow. If we don't see that type of throughput and seeing value come out of the other end and present it to the customer, present it to the consumer, then what do we have? We have a bunch of spend with not much value. Well, I don't think that's going to work for long. We'll see what we get. We're going to have to go through it to figure out what we have. All right. So we caught that. Looks like magical self. You want to look at, maybe I hit on the wrong stock, SPGI. And that's S&P Global. These guys they run the S&P, and they've been a pretty consistent performer, but not, I guess I got them confused with something else. They're down. Then the 5 years up 36%. It's a big cap, 148 billion and $14.7 billion in debt. Very small dividend, high PE ratio, strong buy 25%. Now, what is surprising is the stock market's been flourishing. Why are these guys down? I can understand today, and these guys didn't go down much today, but something's going on. What is driving down their stock price? Not sure, but this is a very well-known company. They have been growing, 10% growth rate. That looks good. Big company, 14.7 billion. So that growth is pretty chunky. They drive good free cash flow, nice high free cash flow, and they have good margins. So if I take their cash flow, they're a good grower, good profits, and I think high level, multiply it times 20. That'd be roughly 108 billion. And let's multiply the same number by 30. That would be 162 billion. So my range would be from 108 to 162 minus debt. Let's see what they have in the debt category. They have a little bit of debt, about 10 billion. So deduct 10 billion from those numbers. So we're roughly, this is a $100 to $150 billion market cap value business. And they are at 148. So they're fairly priced in my book. They're really priced at the upper end of my valuation. If I take a swag at it, but it's a pretty accurate swag based on their free cash flows. It's going to price out at 125 billion in value, and it's going to be priced a little too expensive. And that's the market's kind of telling us that too. It's not really bidding up this stock. It's just kind of going sideways, showing that the market's not convinced that this is a stock worth having. So not an opportunity for me at this time. Growth isn't exciting enough, and the cash flow isn't high enough. PE is high. So we'll see where that goes. Thanks for asking, Magical Self. And Cartel Raider, we covered nice. Where's it? Oh, maybe that's just a comment. We covered nice earlier, by the way, in case you were interested in that one. You'd like to look at Wix? Glad to. Wix is a good stock. It's a good company. It's a company that produces website software. When we look at Wix, right, it's a small cap, 7.47, and the stock has been selling off quite intensely, 37% down. And this stock for a while was doing okay, but for the 1 year, it's down. For the year to date, it's down a lot. And let's take a look at the fundamentals, and I'll show you my valuation. Analysts think it's discounted by a big amount. P ratio is a little high for the current year. Next year is going to be quite rational. 13% growth, which is good growth, not great, just good. And the revenue is 1.869. So that's a pretty good revenue number, pretty good growth. Gross margin, 68%. They're not quite 80, 85% because they're running websites. What does Wix do? If you have a small business and you'd like to have a website, you could easily create one on Wix. They'll charge you a monthly fee, and you would be paying them to have your website with them. I think it's a good business. It's not at the superb gross margins that you would see like a nice software company or biotech company have. 68 is good. 68 is pretty good gross margins. The free cash flow yield is very good, and profit margins are good. So a lot of these numbers are good, but the market's really selling this off. I think it's selling it off too much and providing an opportunity for investors. The analysts think, the most optimistic analyst is at 255 price target, 166 being the low price target. So these guys, the analysts believe this is highly discounted. The growth is going to continue. That's really consistent growth. I could totally see like an Intuit buying Wix. This is the kind of business Intuit's into. Like, buy something that could complement their portfolio of different softwares they sell to their clientele. Wix is a good option for like an Intuit or somebody else to acquire as a business. Their profits are really going to expand. Either their stock price is going to go up, or these guys are going to have a really low PE. I'm an optimist. I think the stock price is going to go up over time. When I value Wix, I come up with a very good number. which is why I own Wix. Small portion of shares, but I think it's a fantastic opportunity to buy a software business that provides website software, website services, which is a necessity for business nowadays. So Wix is looking good. It got sold off today. It's a small cap, so everything's getting sold off today. So Wix is looking good. Glad I own the shares. Thanks for asking. Cartel Raider. Spinoto Dragon. Good to see you. Just a reminder, if you want me to look at a stock, $5 super chat or become a member. And then you can request NXPI and I can cover that. Pedro Miguel, let's go over Ferrari. Ferrari went down today. And it's been a stock that if you look at the fundamentals, it was priced too high. Let's take a look at it. Year to date, 6.85, 1 year. See, this is what I remember. They had done quite well. These guys are obviously an exotic car company. They make a lot of their profit from all the licensing, like people buying, Ferrari shirts and apparel and, Ferrari being licensed in a variety of ways. And of course, they make some money on cars, but cars businesses are not all that profitable. Let's take a look. Market cap, 71 billion. P ratio is pretty high at 38. Forward P at 35. When we look at their growth, nice growth, 9%. Now they announced their earnings. Is this for the quarter that just ended? Let me take a look at. So November 4th. Maybe they just announced that. Yeah, I think car companies are announcing what their sales figures are, but they didn't announce their earnings. They were announcing how many cars they were selling. Got it. Okay. And these guys are growing 9.34% trailing 12 months. It's not a bad growth rate, especially they're getting bigger and bigger. Free cash flow looks okay. And their gross margin is 51%. For a car company, 51% is excellent, by the way. If you look at Ford, it's much lower. I think Tesla's better than Ford, but not quite as good as 51% here. Their profit margins are quite good, 22.9. Free cash flow margins are good. But when we take a look at this number, knowing that they're growing at about 10% per year, I would multiply this times 20. So 1.85 times 20, we're going to get basically $37 billion of value minus debt. 37 billion minus debt. And they have a little bit of debt, $2 billion. So $35 billion is the value of this business. And they're way above that value. So I think it's cool. It's a very liked brand. I mean, who doesn't like Ferrari cars? They're super cool. I've never owned one. Don't plan to ever own one. But if there's one going down the road, right, it's hard to keep your eyes off of it. But this stock is beginning to kind of come down because maybe investors are not looking at the cool cars. They're looking at the numbers, thinking to themselves, why is this company so expensive? And it's really went up in price over a couple of years. And now they have a high stock price that I think is going to come down. I think it's priced about 50% too high. So I'm going to stay out of harm's way and keep myself from buying Ferrari. We'll see where it goes. Thanks for asking, Pedro. And Cartel Raider, you are welcome, sir. All right, so that was Race Ferrari. Good one. It's an interesting one. All right, so let's keep rolling. I've got a couple more stocks to go over. Of course, if you guys, especially the members, would like to look at a stock, let me know. I'll cover it. But I'm just going to keep rolling until a request comes out. If you're not a member, no big deal. Put in a $5 super chat or become a member, and then you can request a stock to be analyzed. Here we're looking at Robinhood, and this has been a really, really good stock. I have no complaints. I am good to go. This has been a very, very good compounding stock for me. $123 billion market cap, revenue 3.57, PE of 70, forward PE 69. These are high PEs, but they are growing quickly. They're a fan favorite to investors who use their software, their platform. I think they get the younger investor that's very technology capable, that grew up with an iPhone in their hands, and are really successful in attracting new businesses. They're also successful in starting new businesses, like their whole gambling business. Now these guys, the revenue growth, 59%, very good on a pretty good number, 3.5 billion. That's very, very good. Gross profit looks good. In fact, gross margins are 71%. And you see how they've grown over time as they're finding products like prediction markets is the latest product they have. In prediction markets, they ended up announcing that they formed 4 billion contracts in their prediction markets business. Of course, they do stock trading, they do crypto. They want to do more crypto in the form of taking stocks and tokenizing those stocks and then selling tokens of those stocks on their site. So they're doing really innovative things that could really mean a lot. And these guys have kind of been underestimated. It's kind of like Robinhood was, hey, that's a retail app, doesn't really mean anything. Well, it means a lot now. It's doing great. So I like their margins. I like their whole story. Profit margins 50%. That is great. Of course, if we get into a bear market, it's not going to be a fun time at Robinhood, because investors, when stocks start selling off, right, they don't trade. They kind of freeze. A lot of them do. Now, not me, hopefully not us, right? We keep analyzing. We look for opportunity. We make our decisions independently. I never provide financial advice. Everybody makes their own decisions independent. I just share my research. But acting when you have really bad markets where you have stocks selling off, that's the most important time to stay in the game. That's when you can make a lot of money by buying stocks at the right levels. But retail investors tend to freeze when stocks sell off. What that means for Robinhood is less trades, less revenue, and that could really impact them. Now, I'm in it for the long haul because I just really like their whole mission statement. I like their strategy. I like their culture. I am good with Robinhood, and I think they're discounted at this time. Some analysts think it's also discounted. The best price target out there is $170 per share. Lowest one at 47. And they think collectively that the stock's priced 20% too high. Now, I have a different valuation on Robinhood and believe that the stock is being sold for less than its intrinsic value. Now, I don't know what's happening with my Google lookups, and we'll see if it's going to work with me here. There we go. I think there's a 40% discount on Robinhood because of its growth. Its growth is really good. Its cash flows are excellent. So I'm not buying any shares. I own plenty of Robinhood. I have to be careful not to load the whole boat with like 2 stocks or maybe 3. I like to diversify and spread my risk across good quality businesses One of them being Robinhood. Robinhood's one of the more exciting businesses. It's really, really, really done well. So Robinhood was down quite a bit today, but it's not something I'm overly worried about. It just comes with the territory. You're going to buy a stock like Robinhood. If we have a day like today, we had so many stocks sold off, this one is going to take a pretty good haircut. Carlos, so ESTC. So ESTC was green for you. All right. I have like 40 stocks, and out of those 40, 2 of them are green. CVS and Kroger. Elastic, look at that, up 6%. Elastic, a search artificial intelligence company, provides software platforms to run in hybrid public-private clouds, multi-cloud environments in the United States and internationally. Okay. So are these guys software or a data center company? Oh, very cool. Looks good. Yeah, this looks interesting. And it's incredible that they went up. Wow. So these guys are the real deal. This is an AI software company. It's a platform, and you can build AI functions, agents, bots, that type of thing. And you can create functions that are doing these things like machine learning and doing things that observability, observing your whole infrastructure and looks good. Looks like a very good use case. Where are these guys located? So they are in the Netherlands. Okay. So good business, 9.19 billion in market cap, revenue 1.55 billion. All right. Analysts think it's discounted. The growth is good. It's not stupendous, but it's good. 17% growth on a $1.5 billion number. It's very good. And gross margins are very good at 75%. They are yielding a good free cash flow margin, not quite profitable, no big deal, because they're young, they're small. But that free cash flow really floats my boat, and they've really grown their free cash flow. So I think I have a valuation on these guys. So 314 billion. These guys are worth that 9 billion for sure. Let me take a look at my valuation. Yeah, I think they're 26% discounted. Good growth company. I'm not an owner of their stock, but it looks like they're doing quite well. I'm glad they went up for you. That's a good one. All right. So good stream, everybody. Thanks for tuning in. I appreciate it. Let me write down Elastic. So let me go over 2 winners that I had today. Now they were only 2 out of a pretty good list of stocks that I own, but that just is the day that we had. CBS went up, and CBS has been getting it done. Look at that year-to-date number. And its reason for it is it was so sold off. Buying it at the right time was a really good idea. I was sitting on a solid gain, and I don't care about dividends, but these guys pay a good dividend, 3.4%. So you're winning 2 ways. You're winning with price appreciation, and the dividend is being paid. $98.8 billion market cap, very high revenue of $384 billion. Low PE ratio, especially on the forward PE, which is 2026. Company just keeps growing, getting bigger. They don't have high margins, but their scale is so big that they create very good free cash flow. And I think this cash flow is going to return to the heydays of 10, 13, 15 billion. When it does that, I think this stock is going to double or triple in price. Profit margins are low because that's the type of business they're in, prescriptions, but their business just keeps growing. They keep becoming more dominant. And part of it is that their competitors continue to falter. The biggest, disaster within their business or within their industry was Rite Aid that went bankrupt. But even Walgreens hasn't been doing all that great. Well, CVS has been operating quite effectively. So CVS is in really good condition, operating well, executing well. It looks really good. Glad I own the stock. I own quite a bit of CVS. I'm glad. And it's a part of the healthcare space, and I think it's 30% discounted. They do have a little bit of debt on their balance sheet, 60 billion bones, but they are a high revenue business. So I think that's going to be okay. That's why I had a little bit higher discount rate, but I lowered it to 8% since interest rates are falling. CVS was a good stock for me. I'm glad that I own it. It's a good stock to have that's going to weather the bad times quite well. And, even in good times, it was doing okay for itself because it was so discounted. Buying a stock at the right time is really, really an opportunity to take advantage of the market's misunderstanding of a company and discounting it too much. And that's what I tried to do on CVS. The other company that I had go up today was Kroger, retailer of groceries. And this stock I was buying both CVS and Kroger, by the way, for the last 2 months. It's got a modest discount, but this is just a consistent company, very well operated. These guys are just a really good example of what businesses should try to be. And when we look at Kroger over the last 5 years, it's just a really good stock. I have no complaints. 5-year stock is up 97%, pays a 2% dividend. So you go 2 times 5, that's 10%. Really, it would be higher because you compound it. So we're above 100% overall rate of return. That's excellent from a company that's going to weather the bad times quite well. So I'm good with Kroger. Nicely done, Kroger. It's good to see 2 stocks hold on. Just tough it out during the storm. Looks like Anthony is on the stream. Good to see you. And yeah, I agree this could be a good opportunity, but for me, I'm going to take my time. I'm not going to be in a hurry to, jump in head first and buy a bunch of one stock or the other. I'd like to see how deep we're going to get on this sell-off, and we'll see where we go. Little J, I do have some earnings streams. I need to get my schedule organized because there was some events next week that I wanted to attend. I'm not quite sure I'm going to be able to stream the earnings this week coming up. Most of them are in the morning, like JP Morgan and all the banks, I believe, are on Wednesday morning. We can check that out. We can check that out right now. So the short answer is I plan to stream and cover those earnings, but I just got to put some thought to it. So Monday, nothing big. Tuesday's the morning. And it's in the morning. So I'll see what I can do to cover the earnings that morning because we have JP Morgan, Johnson & Johnson, Wells Fargo. These are some pretty good caps. Goldman Sachs, BlackRock, Citigroup, Ericsson, Domino's Pizza, Albertsons. Man, a lot of good companies on Tuesday, Super Tuesday. And then on Wednesday, ASML. Man, ASML has been doing well for me. I don't own a lot of shares, but I'm glad I bought it when the buying was good. Bank of America. And this is all before the market opens. So it's like a morning time earnings week. Abbott Labs, Prologis, Morgan Stanley, PNC Financial, Kinder Morgan, which I believe is in energy, United Airlines. These will be after the market closes. So a lot of names on Wednesday, and then Thursday, TSM, again, before the market opens. These guys are in Taiwan. So they're going to announce in the middle of the night. So investors will have plenty of time to analyze it before the market opens. We got Charles Schwab. This is, I believe, more like an insurance company, Marsh McLennan. And then New York Mellon Bank, Infosys, US Bancorp, a railroad after the market closes. So a lot of action next week. And then on Friday, American Express, Schlumberger, which is in the oil energy business. They do services. They don't own the oil. They just help oil companies extract more oil and do all the things they need to do as a business. So it's going to be a big week. I'll try to get my streams kind of coordinated. Just the morning streams to do earnings call are, a little tricky. So I'll try to do the best that I can on that. All right. So Michael Anthony, good to see you. So how do I dollar cost average? So I usually, for example, Meta I bought over time, and there was times when it was just really priced really well. So I would buy like consistently, maybe for a month or two. And I built up a really big position of Meta. And I try to buy on sell-off days. Like today was a perfect day. I did buy some shares in a couple of different companies, but the market will offer up some days when it just sells off harshly. Well, not quite this bad. This doesn't happen a whole lot, but when it does, having a dollar cost average strategy enables me to take advantage of this. For example, if let's say I'm buying an Amazon, but if I decided yesterday, hey, I'm just going to buy a bunch of Amazon stock. Boy, I'd feel bad today that it went down 5%. Instead, I take advantage of it and I bought some Amazon stock today. And I'll continue to buy it. I'm planning to buy a lot of Amazon. I think that's just going to be an important company and I want more of it. And I'll hang tight on Meta, Google, Robinhood, Uber. I own plenty of those and I'll just hold those. So I think, dollar cost average, it also fits. I know a lot of people are working, professionally and over time, maybe each paycheck, you're putting, a couple $1,000 into your brokerage account. You can dollar cost average probably to fit the way that you're funding your portfolio. So that's one way to think about it. I think that's one reason why I dollar cost average in my investing career is I've consistently put money into my savings / brokerage account, but that's been over time, right? It's been 30 plus years. I didn't win the lottery 30 years ago and then voila. Okay, great. Now I'm a dollar cost average. No, it was over time. I make money. I'd make more money in a given month. I'd put more money in the market and just decided dollar cost average made more sense for me. And that's what I'm going to do. So thanks for asking and good to see you. All right, guys. So I'm going to go ahead and land the plane. It was great to be with you. I appreciate you tuning in. And let's see what happens on Monday. Boy, a lot of eyeballs are going to be on the stock market on Monday, huh? To see if the market's going to continue to sell off or if we're just going to bounce back. I don't know what's going to happen. This market has been going up so much. I'm just used to the market going up. A day like this, man, it's like, whoa, where'd this come from? But I understand the reason for it. Tariffs could be an ugly thing for the economy, for these businesses. So if the tariff story doesn't go away, then we're going to be in this rut for as long as it takes for the U.S. and China to be cool. and we'll see how that goes. All right, little J, enjoy. Go USA. World Cup next year. Looking forward to it. And the World Cup games are going to come to the US. I think they're going to play some in the US, some in Canada, some in Mexico. And the final is going to be in New Jersey at MetLife Stadium. So it should be really fun to watch international soccer, international football next year. All right, guys. You guys have a terrific night. Have an awesome weekend. Get rested up. We're going to start earnings next week, and we're going to be nice and busy. Fingers crossed that tariffs go away and we have a good sell-off to bring down some stock prices and give us good opportunities, but not too much of a sell-off. Let's kind of be measured with the sell-off. If the market could please do that. It was terrific to be with you guys. Have a good night. Thanks again.